Good afternoon, everyone, and thank you for joining us today. For those I haven't met yet, I recognize a few names in the attendee list, but not everybody. I'm Max Kahn, CEO of Digital Wealth Partners. We're an SEC registered investment advisor focused on helping our clients navigate the digital asset landscape through a fiduciary first approach. At our core, we focus on combining institutional grade infrastructure, qualified custody, risk management, and thoughtful portfolio construction with broader wealth management frameworks and really blending the worlds of traditional wealth management in this evolving digital landscape. As this space continues to evolve, our goal is to help clients move beyond simply accessing digital assets and towards managing them more strategically. One of the biggest shifts we're seeing right now is how investors are thinking about digital assets more broadly. Historically, it's been buy and hold. And while that still has a place, the conversation's changing. Clients are asking how to put these assets to work. We're seeing this with high net worth individuals, with institutions, and importantly, this isn't just happening with Bitcoin. We're seeing it across all digital assets, including XRP and other ecosystems as well. A big part of our ethos at Digital Wealth Partners is how do we take what would otherwise be a dormant asset and put it to work in a thoughtful, risk-managed way? And after that, how do we democratize access to high quality, institutional grade strategies with quality managers and lower those barriers to entry? So with that, I'm really excited to have Alex Blume, CEO and co-founder of TwoPrime, joining us today. Alex and his team bring deep experience and expertise across derivatives markets, have built a strategy focused on generating Bitcoin denominated returns through a systematic approach. Alex, really great to have you here. Really appreciate you taking the time. And maybe a good place to start before we jump into the strategy is just level setting on Two Prime. We'd love to hear a little bit more about your background, what you've built, and what you think about Two Prime's role in the market today.
Thanks, Max, and thanks for organizing this. It's great to be on with you. Um, I've worked in finance since I got out of college and about 20 years ago now. Oh man, I'm getting old. I and Part of that time was working at a hedge fund that traded VIX derivatives. I was working at a VC fund that was related to Bitcoin in 2012 and was always just fascinated by what Bitcoin meant for the kind of internet of money. So in 2019, we saw that a derivatives market emerged for Bitcoin, where you could now trade volatility and do all these more sophisticated trading strategies that we were implementing on public market volatility trading, like UVXY or VXX. And so I thought, hey, I think we could take these same strategies and apply them to Bitcoin. And actually, the vol on Bitcoin was very volatile at the time, about 130 implied vol when we first started in a very new market. And that's since come down. I think it's in the 40s or 50s today, but it was
Wow.
in the 30s for much of last year. And so we started offering that to institutional clients. One of our first clients was one of the founders of Tether, and he came to us and he said, "Look, I'll give you 1,000 Bitcoin." I think Bitcoin was at like $30,000 at the time, but like 30 million bucks. And I just want to make 5 to 7% on my Bitcoin every year. I don't care if Bitcoin goes up 200% or it falls in half or it stays flat. I just want smooth, consistent returns without a lot of craziness. This is somebody who really deeply believes in the future of Bitcoin and wants to hoard it. But if he can compound that, even a 5 to 7% compounding return is actually quite a bit over a 5 or 10 year time scale. And so that was what we designed basically for this client. We said, okay, how do we build this product? They don't typically want to be in a fund because there's a bunch of tax problems with a fund. You're stuck in a rigid strategy that may not be what you always want to do. The redemptions and additions can be more rigid as well. And so we started offering separately managed accounts. And so that's what we've been doing for the past almost 7 years now under Two Prime. We are an SEC registered investment advisor. We are a CFTC registered CTA, member of the NFA, which is the advisory or regulatory aspect of the CFTC. We're a broker dealer branch office as well. We've always just tried to provide an institutional buttoned up approach to producing Bitcoin denominated returns on Bitcoin. We also do Bitcoin backed lending. We're one of the largest Bitcoin backed lenders in the world. I think we work with 8 or 9 publicly traded companies at present, and then a lot of crypto OGs or early buyers of Bitcoin as well. And yeah, that's Two Prime.
Oh, it's a great story, and we're really excited to be deepening our relationship with you as such a recognized and quality name in this space. It's really impressive to see what you built and how early of an adopter you and the Two Prime team were in this. And what we're seeing is what your early days client was seeing, back in 2019, right? It's a real shift towards institutional quality, execution, and risk management. So it's no longer just getting the exposure; it's how do you manage that exposure. And you mentioned that drop in volatility, right? From 130 down to 30 and now sitting somewhere in the 40s. What do you think's led to that in recent history? And maybe we can talk about a little bit about where we are in the market today.
Yeah, I think any asset as it matures, it tends to lower in volatility because you have different kinds of market participants trading the asset for different reasons and in different ways. Over the last year, we saw the like basis trade on Bitcoin. So own spot Bitcoin and sell the future, and you can capture a premium between there. It used to be when we first started, you can make 20% in this delta neutral kind of risk free, as close to risk free as you can get type trade. And that is very exciting to people. And so as we saw ETFs roll out in the US, then US hedge funds and regulated US institutions were able to basically take advantage of that basis trade. And so they just traded it until it's gotten compressed a lot there. I think another aspect is more institutional digital asset treasuries or large holders of Bitcoin now have more of a mandate to produce income or a return on their Bitcoin. So they're
Hmm.
selling calls or they're participating in other kinds of systematic selling strategies of volatility. And again, this just compresses and compresses the spreads on some of these trades, even below what probably is a rational amount.
Interesting. That compression really defines the digital asset market today, right? It's defined by volatility, this rapid shift in positioning, and for a lot of investors who aren't doing the systematic things you're doing, that can feel uncomfortable from a traditional buy and hold perspective, right? The sell-off we've seen over the last 6 months can be uncomfortable for people just buying and holding this asset, but maybe that's actually where the opportunity is created. And we've seen sharp moves lower, spikes in vol, extreme funding rates and dislocations across the derivatives market. And I think that's where strategies like the one we're going to talk about can operate. Really, again, just reemphasizing that broad shift from simply holding these assets passively toward actively managing them, focused on yield, like you said, risk, capital efficiency. So, in this environment with the rates compressing, the vol compressing like it is that something to be extra cautious about, or is that where you and the two prime team are seeing a lot of real opportunity created?
Well, I think there's a couple of different ways to manage uh, changes in market structure. One is if you start seeing a really crowded trade, then there's some trade on the other side of it that's going to make sense at some point. And so, if everyone's selling short volatility, when you get a volatility spike, you're going to get a squeeze on the other side of it. So, are there ways to position for the other side of that trade? Because it just can't be everyone sells calls forever and
Yeah.
everyone makes money forever. There'll have to be some surprise or upside to it. You can't predict exactly when that's going to play out, but you could, position yourself to take advantage of something like that. You could also, you know, like for example, realized vol versus implied vol. Implied vol has always been in excess of realized vol, almost always in the history of Bitcoin up until last year. And so now that means now if you're selling implied vol and your realized vol is outstripping it, you're not making money anymore. You're losing money because you're selling something for less than the reality of what it's worth. And so get out of the trade or flip the trade to the other side of it might be another thing. I think another way, I mean, just generally, if it depends, some people like their whole life's worth is in Bitcoin, and then you're gonna have volatility no matter what. Like it's a volatile asset, unless if you have your life's net worth in Bitcoin, you probably don't want to short Bitcoin a lot. Otherwise, you wouldn't have your life's net worth in Bitcoin. But another way to manage the vol is just through sizing. You hear a lot of advisors say 2 to 5% of your wealth in Bitcoin. It has a lot of asymmetric upside, or it's a good risk-adjusted return. But maybe if you need to pay your mortgage with this money next month, it's probably not the right thing to be holding for something like that. Beyond that, I mean, we can get more into the tactical ways that we trade, but when you see sharp movements or crowded trades like we discussed, there's a lot of tactical trades you can make that are risk managed, but allow you to take advantage of some of those market dislocations.
Yeah, and your team has been really impressive with doing just that. And if I understand correctly, you guys haven't liquidated collateral in the history of this strategy, if I'm not mistaken. Is that accurate?
Correct. I mean, there's individual like we're trading multiple pairs of futures and options at different times. So some of those by design are losing trades because there's a trade on the other side that's more winning. But overall, we haven't never had a liquidation where like the whole book blows up because we didn't manage risk properly, or and we've never come anywhere close to something like that.
Yeah, and your team is especially good at managing risk and looking ahead, right? So it's less about predicting direction and more about understanding how the market is functioning underneath the surface. And I think you've put together an incredible team to realize and capture those opportunities. So how do we stay exposed in a more disciplined and systematic way? And I think maybe that brings us into the strategy itself, right? So talking about how we get a little bit more tactical. At a high level, can you talk about the strategy and how you intend on capturing these opportunities and what's happening under the hood?
Yeah. Well, first, I'd say we do separately managed accounts. So we have different clients in different kinds of strategies. Specifically, what we've seen in this market environment that most people want, and I think what we're rolling out to DWP's network is this core plus strategy. So we offer, in general buckets, core plus, and aggressive. Aggressive is like I want all the volatility and double digit style returns. Core is I don't want much volatility at all. And then there's something in the middle, but really the core plus leans more on the conservative side. So, the core strategy, which is supposed to be very predictable and low volatility, low drawdown, is basically trading. It's arbitrage. We think delta neutral arbitrage is the best way to make predictable returns in Bitcoin. It's a volatile asset. You don't know. I don't want to be guessing if it's going to go up or down tomorrow. There might be a tweet this weekend, and I don't know. We're invading Iran. The war's over. I don't know. Like the world's ending. The world's starting over. Aliens are coming. I don't know, but I don't want to have to guess what's going to happen to the price of Bitcoin. But if I can do arbitrage where I can look at the historical cost of a certain instrument, like a dated future versus a perpetual future, and these are perpetual futures is kind of a crypto specific future that never has an expiration date. That pays a funding rate every 8 hours. So if you're short a perpetual future, you're actually getting paid most of the time effectively to lend Bitcoin to somebody else. And so what you can do is you can pair these trades in ways where that's delta neutral. So if you buy a dated future and you're short a perpetual future, you're hedged equally in both directions, but now you're getting paid for the cost of those premiums. And it tends to be that dated futures and perpetual futures don't cost the same amount of money all the time. And when you get price movements, they actually move at different speeds and in different ways. And so that kind of derivative of the derivative, the change of value of those things in market conditions is one way that we look to make money that's highly predictable. And even if you're wrong, the way you could be wrong is like maybe your funding rate on the perp is lower than expected. So you bought something that cost 4% and the perp is paying you, it turns out over a year paid you 3%. So you're wrong, but you're not wrong even in a massive way. And you could see, hey, we've been wrong for 6 months. We lost a 0.5%. It's not like you wake up one morning and you have half as much Bitcoin as you thought you had. So these are very controlled, predictable ways. Even when you're losing, it doesn't happen like overnight in some big bet sort of fashion. So we kind of see that core strategy as the engine or main driver of a predictable return, but it does not produce double digit returns. It produces like on historically like a 3 or 4% return. And basically that's just the difference in funding costs between a dated and a perp over time. And right now, even that is compressed more than it typically is, though that won't last forever. Then the next layer that I think is where most clients end up feeling most comfortable is in this core plus strategy. So there we're using this core engine, which produces basically you're playing with some house money of some return that's pretty predictable, and then saying, how can I take little bets across what we look at six different buckets to understand ways to make money and take little bets. Maybe they're 1 or 2 day trades, maybe they're week or month long trades, but it's not this persistent trade that we expect to last. It's like, hey, a great example is in early February, the price of Bitcoin dropped to 60K. We saw perp funding rates go negative, which they're almost never negative, and it was like negative 20%. We saw implied volatility spike from 35 up to 100. And like these just numbers cannot last. You can't have a 3x spike in vol, and vol is not going to stay there. Just like if Bitcoin goes up 500% in a month, you got to think it's going to come down sometime soon. Or if you're making bets, that's a pretty good bet to make at that point. And so in that case, we bought, I think, 3 or 4% of perp exposure to the upside. When you're at the market bottom, every metric is telling you this is an extremely stressed market. We'll take some exposure. That's our price bucket. But even there, it's not like 100, like we're not like 2x leverage. It's the most risk managed leverage so that we can look at 1, 2, 3 standard deviation moves and still know that even the impact, if we're completely wrong, is something very manageable. The next thing we can look at is volatility. So implied volatility is, when you have an option, there's a price in it. Part of the cost of the option is how much variance is expected in the underlying asset. And so if something varies a lot, then the option should be worth more because greater variance means you're more likely to hit any price that exists. And so you can look at historically what has been the implied volatility of Bitcoin over the last 7 years, 5 years, 1 year, 3 months, week, day, and you can rank it and say, okay, and over the last 3 months, we're in the 2 percentile. It's in the almost lowest it's ever been over the last 3 months. It's reasonable to think maybe you're on the edge of a trade where it's going to revert back to something closer to the average. It's not guaranteed to happen, but it's a good mathematical bet to make. So that's another bucket we're looking at. Another one is skew. So,
Before you jump into skew, a
sorry.
couple of things
Yes.
right there, and I really appreciate the level of detail, and you're clearly the expert in this space, right? Like you you
Is this
you
too
eat,
much?
sleep, and
Is this too
breathe
much
this.
detail?
No, this is wonderful.
Oh,
I
okay.
love it. And I love the technical, and I do want to touch on skew. I just want to highlight all the key differences, and maybe zoom out for some of the investors here who aren't as familiar with with these terms, because rather than relying purely on directional appreciation, what you're doing is generating returns by capturing, like the simplest way I could put it is capturing inefficiencies in the market, right? So whether that's in options markets or funding rates or the basis trades themselves, you're still maintaining this exposure, but you're able to hit these singles and doubles, like you said, the 4 to 7%. You're not swinging for the fences of those 20% returns and maintaining this exposure. But doing it in a really risk managed and controlled and tactical way. And importantly, before we jump back into skew, because I do want to pick that back up, these returns, everything that Alex is talking about, the returns themselves are generated in Bitcoin. So this is Bitcoin denominated returns. So you're actually growing your Bitcoin over time. It's not just producing dollars, which is particularly exciting. A couple of things that I want to point out from the mechanics of this strategy, right? And this is between DWP, TwoPrime, and Fidelity being the actual custodian. So when we're moving the Bitcoin out of Anchorage, if you're a DWP client, and into that Fidelity segregated wallet, your assets are sitting in Fidelity. They are TwoPrime has worked out a margin release, a Bitcoin denominated margin release. So a lot of the time, margin is released in dollars, but this is a Bitcoin margin release. So you're getting 1 to 1 on your Bitcoin. So every Bitcoin you have sitting in Fidelity, you're getting a Bitcoin of trading capability on Deribit. And Alex, you can jump in and correct me if I'm wrong here, but your Bitcoin is sitting safe within Fidelity, and you are taking a really active risk managed approach to trading that margin of Bitcoin at Deribit. And I think that off-exchange settlement structure that you created is incredible and really the future of this space. And I just wanted to highlight that and maybe zoom out a little bit. And with that, I'm happy to turn it back on to you to talk about skew
Yeah.
and where
I
we're
think
going on that side of
I
things.
think it's important to mention because there's, in all of crypto, there's massive tail risk, like things you never thought would happen.
Mhm.
And one of the biggest ones is exchange risk or hacks. And so for our clients, a lot of them public companies, we get 100, 200 question diligence packets. And one of the questions is, where does the Bitcoin sit? That's one of the biggest questions in all of crypto, I think, is where is the money? And so for us, we work with Fidelity. The Bitcoin never leaves Fidelity, and the exchanges we work with can see it's at Fidelity, but it doesn't actually have to leave Fidelity at any point. And then, there's variance of gain or loss on the exchange, but there's no movement of the actual Bitcoin. So that I guess, Fidelity, I guess like we get like quantum computing and everything gets hacked. But in terms of Bitcoin custodians, I don't think you could do much better than Fidelity for security and robust institutional partnerships. So, that's been important to us and important to a lot of, it's part of why we work with a lot of public companies. On top of that, we ourselves are SOC 1 and 2 compliant. So we've gone through a whole process of every single time any money moves, there's multiple people have to check off. There's so many processes. It's like the bane of my existence, but also very important to public companies that you have these SOC compliance layers, which I think very few asset managers in crypto have gone through the trouble of doing.
Yeah, it's one of the things that stood out to us when we started working together. That's your approach to risk, right? Like you really have dug into this. You're working with some of the largest names and custodians and publicly traded companies in this space. And if they're trusting you with their treasury, obviously we're doing our own diligence, but we've known each other for a while now, and work and putting together this custom strategy. But it gave us, so much peace of mind to know who you're already working with, the systems you already have in place, and that you were able to hand us all of this diligence pretty quickly, which speaks volumes to the market readiness of you and your team.
Yeah, of course. And I just, if Bitcoin's going to $1 million and we're trying to only grow it 5 or 8% a year at a net of fees, there should not be massive tail risk in any of it because like it's worth so much or its its net present value is so great. If it's really going up to those values that you better not lose it in the process of trying to make a bit of a return.
Yeah, and from an access standpoint, and I think that's really important too, because if you were to go directly to two prime, your typical minimum is somewhere around $10 million for your mandates. Is that correct?
That is the minimum. Yep.
All right. Well, thank you for working with us and through our relationship and deepening it, right? We're for digital wealth partners, as I mentioned earlier, it's really about democratizing this access. So we've been able to lower that barrier of entry, making this initial strategy accessible to clients at $500,000 worth of Bitcoin, so significantly less. And that ties back to our core ethos and yours of quality and access. And I didn't mean to cut you off with Skew because I do want to get back into that. And I would love to hear a little bit more about how you think about, you gave some really great real world examples of what's happened in the market recently, but you're not taking large directional bets. It's about structuring trades in a way that's controlled and measured and repeatable. Can you talk a little bit more about the Core Plus strategy itself?
Yeah. So well, I would add also, for all of our accounts, there's also a third party admin that every month produces a statement. In the case of with you guys, every, individual sub account for every person you bring will have an admin looking for you and verifying the funds are what we say they are. And yeah, so just want to add that as well. And we also, I mean, we're also audited by the SEC. We get a surprise audit from a third party accounting firm every year where they come in, we don't know when, and they also they pick random accounts and verify it. So there's a lot of layers of oversight here, which is great. I don't want people to worry. We try to be as transparent as we can be. Um, Going back to Core Plus, so you have this core strategy, which is this kind of persistent trade arbitrage across perpetual and dated futures, and then these six buckets of tightly risk managed returns. So the next one we talked about price, we talked about volatility. The next one is skew, the third bucket. So skew is a measure of the cost of a put versus a call. So if it costs twice as much to buy a put 10% of the money than it does to buy a call 10% of the money, you have skew towards the put side. And it's has to do with sentiment. Like if the market's crashing, it makes sense that puts cost more than calls. Um, but often this is mispriced too. Just like any of these other instruments, if you start flying down and you start hitting levels where it stops flying down, that cost of that put still remains persistent for sometimes, and that call might stay cheap for sometimes. So you can do trades where you're delta neutral in the sense that you're buying exposure in both directions. However, one costs more than the other, and you're betting that, hey, I think puts are too expensive here, and I think calls are too cheap. And so I'm going to put on a trade that takes advantage of that. So when it corrects, I own the right amount. And the same, you can look at the historic cost and the historic skew and say, hey, this is mispriced or statistically abnormal for where the market is today, and something that will probably revert back to some kind of mean, not the price of Bitcoin itself, but this ratio of the cost of puts to calls. And so that is another trade that we can put on. And again, like if you're wrong, you're wrong in a little way. There's not a lot of tail risk in it. So you might say, oh, we thought calls were going to go up 20%. They didn't go up 20%. And, we lost a little bit, but it wasn't like you're betting the whole business on one trade.
Hmm.
Another place we look at is term structure. So, for example, in 2024, it feels like a long time ago, before the election, there was a lot of speculation around who was going to win the presidency. And so, option exposure or even futures exposure after that election date or around the election date was a lot priced very differently than things shortly or well before or well after. And so, what you can do is you can trade instruments that don't have this kind of event cost to it against things that do and get paid for capturing the difference. And so you're not betting on like, is Donald Trump going to get elected president? You're betting on, are these two instruments too widely priced against each other and making bets there. And again, you're maybe wrong in small ways if you lose, but you're never wrong in like, oh, like we lost 30% of our Bitcoin. The next thing is just tail. Right now, for example, calls are historically cheap. And so you can buy a call at the end of the year for like, or a future at the end of the year in like the 2 to 3% range, which is typically these things historically in Bitcoin. Sometimes they're 20, 30%, but they're often much greater than 2 or 3%. So you can, take little risk and say, hey, like, I bet it's going to be more than 2 to 3% in cost for this instrument at some point over the year. And so I'm just buying things when they're cheap and I'm going to sell them when they're expensive. I don't care if the price, like, I'm not betting the price is actually going to go up. I'm going to bet that this cost of this instrument at some point might go up relative to its premium. And then the very last one is um, yield. So basically getting paid for funding rate or basis yield. So we talked a bit about it in the core strategy, but if you can be short the right instrument and long the right instrument, you can get paid for being in those positions. Effectively, you're providing liquidity to the market, contrary to what most of the market is trading or doing, but you can do it in delta neutral kind of ways. So across all of those, though, we're never, again, I just want to emphasize, we're not taking big bets. It's like we're going to take a bet 2%. We're going to bet 2% extra leverage that the price is going to go up over the next month or something like that. And if we're wrong, okay, well, we have that core engine of this ARB that will pay for those mistakes. And most of the time, we're not wrong. So that's kind of the core of how we're making money.
That's amazing, and you're clearly looking at a multi-factor approach here. I'm curious, in today's market, are you seeing more, persistent inefficiencies in the market in one place rather than the other? Is it the options market? Is it funding? Is it basis trades? Like where do you think the greatest inefficiency and opportunity is today across all those factors?
Yeah, I would say probably skew and tail are probably the buckets we're most focused on at the moment. Skew is very heavily negative market sentiment, but I working in Bitcoin for the last 10 years, like this stuff changes in like 2 hours with the right piece of news or change in rate cuts or exposure. And so we think skew is an interesting place to look. And then the tail side of it as well. So like the cost of a dated future out to the end of the year is at places like the historically lowest it's ever been, the cheapest it's ever been. And you might look it around and go, oh, the world looks unsteady and all this stuff. But statistically, it's a good place to place a bet and say, I don't think it's going to remain the cheapest it's ever been forever. And so why don't we get some long tail exposure? Not saying like, if you buy a call that's at 120,000, we're not trying to bet it's going to get to 120,000. We're trying to bet it's going to get closer than the market actually thinks it is or what it's pricing it in currently. And that's all that we have to get right. And we have 9 months to be right about it. And again, if you're wrong about it, these things are so cheaply priced that it's not a big deal if you're wrong.
Oh, interesting. And the way you're talking about it, it's clear the strategy is really dynamic, right? It's not just about positioning yourself daily or weekly or monthly. It's really opportunistic, and you're evolving the strategy as the market evolves. And I think that's incredible. And I know you and your team are watching this every second of every day. But there's a lot of yield strategies in digital assets today. Lending, staking, DeFi. How should clients think about this, relative to those?
Yeah, so I guess a few things. We try to shy away from calling it yield because it's yield implies some kind of risk-free
Hmm.
return, like a treasury. That does not exist in Bitcoin. You get paid for taking risk. You could take risk lending Bitcoin to somebody else and hope that they don't go out of business at some point or go bankrupt. You can take risk betting on the price going up and down, or you can take risk that some some company's going to go out of business, whatever. There's a lot of risks you can take, and you can get paid for being right or being betting on a direction that most people aren't betting or a mispricing. And so uh, we think that first off, this delta neutral arbitrage across perps and dated futures is a very it's a structural risk. It's like an operational risk where you go, oh, like these instruments, there's just different people trading them for different reasons. And so they cost different amounts. And I don't have to divine what the price of Bitcoin's going to be. I only have to predict that this relationship between these instruments is going to persist. And if it doesn't persist, I know I can get out of the trade. And so for us, that is very predictable. I will say that, our motto or tagline at TwoPrime is we generate alpha. Alpha does not stay in one place forever. As soon as we start doing a trade, we're pulling that value out of that trade. And there's a lot of sophisticated other parties doing the same. And so, we think of our approach as systematic, but not fully algorithmic, just because there's no, especially in derivatives markets that are so multivariate, there's no single trade that just works every single day forever. And you just click a button and it's on. But there's a set of trades that we think make sense at different times. There's four guys with PhDs in physics on my team that are always putting together research and trying to get better and better at this set of trades. And then it's a question of when and what market regimes do different trades make sense. And we have a playbook of like when in a bearish market that is highly volatile, here's the set of trades we think is the right playbook. In a middling market that's low volatility, there's a set of trades. There's kind of this, you could think of a grid of basically 9 different market regimes across high volatility, medium volatility, and low volatility, and then bearish, bullish, and kind of what we call a crab market, but a flat market. And there's different kinds of trades you can put on, and we're very good at um, deciphering what regime that we're actually in, and then putting on trades. And then I think the last part of it again is the mandate we have from our clients is first and foremost, don't lose our Bitcoin. Don't lose it because the exchange gets hacked, and don't lose it because you suck at trading. And so, I just can't emphasize how tightly risk managed. Like we'll have a calls where we're like debating for an hour if we should add in 1% extra exposure to a position because it's that tightly controlled. And we also, we have a full kind of budget of how much risk we'll take across any of these buckets. And if you put some budget into one of these buckets, it means you don't have budget for something else later. And so we're always trying to keep some dry powder so that we can move tactically as the market moves as well.
Amazing. So much of what you said resonated, and it really shines a light on why it's important to work with investment professionals and real sophisticated managers in this space. It's constantly evolving, it's constantly changing, and the trades that work are as well. So, as you're looking ahead over the next 6 to 12 months, what are you most focused on or excited about from an opportunity standpoint?
I mean, to me, like I want to get paid. I think there's a huge fracturing of both traditional markets and crypto markets, and then across just different venues on both sides of that. We have new entrants like Hyperliquid, that's this DeFi whole realm of perps that's taking the world by storm. Even when you look at different crypto exchanges, the cost of a dated future or a perp varies pretty widely across these different things. And so that's what's exciting to me is can I get paid to just build pipes between these places and tactically provide liquidity where it needs to go. And so I don't want to, like, I'm not some wizard that knows what's going to happen to the price of Bitcoin, but I can find through research places where things just get priced differently, the same instruments. And I want to get paid to provide money to those places where they make sense. And to me, this is like the most predictable controllable way to make money. We call it like infrastructure arbitrage. So I, there's guys on my team way smarter than me, and there's lots of very smart people in the world. But the ability to span across different crypto platforms and provide that liquidity is very controllable and predictable. If it stops working slowly, and you can kind of get out of it over time or leg in or leg out of things as they start going better or worse. And so I'm really proud. Really, it's more of an infrastructure game of do you have the right setup to deploy to things when the opportunities emerge?
Yeah, great, and fully aligned. And typically strategies like this and working with teams like you, I touched upon this a little bit earlier, are reserved for larger institutional allocators. You talked about your mandate, don't lose the underlying asset. It's ours as well. We know the clients love their holdings. They love Bitcoin. They love XRP, whatever it is. And principal protection is the name of the game right now. Is that the case for your larger clients as well? Like, what's your typical client profile, and how does this partnership, expand access?
I think it is the standard kind of expectation. It's really evolved over like, 5 years ago, we were like, hey, we can make you an 8% return. People are like, well, I'm making 10,000% on my fart coin. So like, it doesn't sound that good. Now just the institutional participants, we deal with public companies that they have boards and like they're thinking about their liability and like lawsuits and are they making intelligent, rational decisions? And so for them, it's always about risk management first. And then great, if you can pull out some yield beyond that or some return beyond that, that's great. And I think especially with the market being down right now, everyone's wallets get tighter because there's not as much funny money to play around with. Especially we work with a number of Bitcoin miners. Like this return we make funds salaries, it funds expansion of their business, and so it's not like a just fun gambling game. It's don't lose my money and let me know if you can do better than that. And then I think lastly, just as the market is becoming more competitive, the ability to just monetize Bitcoin at all is highly valued, but not losing the Bitcoin is the most important thing.
Aligned. And I think that's really the big takeaway here, right? Is protect the underlying collateral. And I think as digital assets mature, we've said it before, the conversation is really shifting from simply getting exposure to how that exposure is managed, how returns are generated, how risk is controlled. Thank you so much for joining us today to talk about that. I'd really like to open it up for questions if there are any. If you are typing them in, and for those on the call, if you're already a Digital Wealth Partners client, please feel free to reach out to your advisor to learn more about how the strategy may fit into your overall portfolio and financial health. Any questions? You were a little too clear, Alex. Everybody understood everything right away the first time.
There you go. Perfect.
Please reach out to the team at DWP if you do have any questions on this strategy. We're incredibly grateful to be working with TwoPrime as such a key part of our foundation and as a partner. Alex, really appreciate you taking the time. This has been incredibly helpful, and thank you so much for sharing your perspective. Uh, I'm sure we'll be talking very soon.
Likewise, thanks for the opportunity.
Thank you.